Donald Trump paid $750 in federal income tax in 2016, and again in 2017. Not because he was broke, because the system let him pay that. Legally, documented, using strategies available to anyone wealthy enough to use them. And he's not the exception. Between 2014 and 2018, the 25 wealthiest Americans paid an average tax rate of 3.4% on their growing wealth. Some paid less than 1%. The average American worker pays 13% before payroll taxes are even added. This isn't a conspiracy theory, it's not illegal, it's not even hidden. It's a system built over decades by people with enough money to buy the rules they wanted. And it works so well that some of the wealthiest humans on earth pay lower tax rates than the nurses and teachers who live on their street. This is every legal method the rich use to pay nothing. Explained simply because the first step to understanding a game is knowing it exists. The difference between income and wealth. Before anything else, you need to understand one thing. The tax system is built around income. Money you earn, money you're paid, money that flows to you from work. That's what gets taxed. Wages, salaries, bonuses, the kind of money most people make. But rich people, genuinely rich people, don't make money. They own things, and ownership is taxed completely differently, sometimes not at all. While you're taxed on every dollar your employer sends you, a billionaire who watches their net worth climb by $50 million in a year owes nothing on that gain, not a cent, because they didn't earn it. They just own assets that became more valuable, and unrealized gains, wealth that exists on paper but hasn't been sold yet, are not taxable income under current law. That gap between earning money and owning money is where everything else lives. The buy, borrow, die strategy. This is the most important one, and almost nobody outside of wealth management circles knows its name. Here's how it works. A wealthy person accumulates assets. Stocks, real estate, private equity, art. These assets grow in value over time, but selling them would trigger a capital gains tax, so they don't sell. Instead, they go to a bank and borrow against those assets. A loan, using their portfolio as collateral. They might borrow tens of millions of dollars this way. And loans are not income. Loans are not taxable. You can spend borrowed money on anything, a yacht, a mansion, a private jet, and owe zero tax on it because technically you have to pay it back. The interest on those loans? Often deductible against whatever small taxable income they do have, reducing the bill further. Then they die. And here's where it gets extraordinary. Under a rule called the stepped-up basis, when assets are inherited, its starting tax value is reset to whatever it was worth when the owner died. Meaning, if someone bought stock for $1 50 years ago and it's now worth $1 million, the inheritor pays capital gains tax on $0 of that gain. The entire lifetime of appreciation disappears from the tax record. The loan gets repaid from the estate. The assets transfer to the next generation. The tax bill, the one that should have existed for decades, is completely erased. Buy the assets, borrow against them to live, die, and pass them on. That's it. That's the strategy. Legal, documented, widely used, and worth billions in avoided taxes every single year. Capital gains versus ordinary income. When a regular person earns $1 at work, it's taxed as ordinary income. At the top bracket, that's 37% to the federal government before state taxes. When a wealthy person sells an investment they've held for more than a year, that profit is taxed as a long-term capital gain. The top rate is 20%. For many wealthy investors, it's even lower. This is not an accident. It was lobbied for, argued for, and written into law by people who make their money from investments rather than work. The logic sold to the public was that lower rates encourage investment. What it actually does is ensure that a hedge fund manager paying a 20% rate on hundreds of millions in gains pays a lower effective rate than a teacher on a $50,000 salary. Carried interest makes this even more extreme. Hedge fund managers and private equity executives often receive their compensation as a share of profits, called carried interest. Under current law, this is classified as capital gains rather than ordinary income, meaning someone whose entire living comes from managing other people's money is taxed at the investment rate, not the income rate. This loophole has survived decades of reform attempts because the people it benefits have significant political influence. Offshore accounts and shell companies. The word offshore sounds dramatic, criminal even, but the vast majority of offshore wealth is sitting in perfectly legal structures in places like the Cayman Islands, Luxembourg, Ireland, or Delaware. A corporation incorporated in a low-tax jurisdiction pays taxes there, not where its customers or owners actually live. A company that makes billions selling products to Americans can route those profits through an Irish subsidiary, a Dutch holding company, and a Cayman Islands entity, paying a fraction of what it would owe in the United States. This is called profit shifting. Every major accounting firm has a team that does it. Every large corporation, at minimum, considers it. For individuals, the structure is similar. A wealthy person creates a holding company in a favorable jurisdiction. Assets flow into the company, income is attributed to the company, not the person, and the tax treaty network between countries, built to prevent double taxation, often ends up enabling no taxation. None of this requires secrecy. It just requires expensive lawyers who know the rules better than the rules know themselves. Trusts, the quiet machine. A trust is a legal structure where assets are held by one party for the benefit of another. It sounds simple. In practice, it's one of the most powerful tax avoidance tools ever invented. The basic version: a wealthy person transfers assets into an irrevocable trust. Those assets technically no longer belong to them, they belong to the trust, which means they're no longer in the person's taxable estate when they die. Estate taxes, which can reach 40% on large inheritances, disappear. Then it gets more sophisticated. A grantor retained annuity trust, known as a GRAT, allows someone to transfer assets into a trust, receive fixed payments for a set period, and pass everything above the IRS threshold to heirs completely tax-free. Wealthy people use GRATs a lot when interest rates are low, because the assets only need to grow a little to beat the IRS benchmark. A spousal lifetime access trust, called a SLAT, lets one spouse transfer assets to an irrevocable trust for the other. The assets leave the taxable estate, but remain accessible to the family. Wealth is preserved, tax is avoided. Dynasty trusts, available in certain states, can hold assets for multiple generations without ever triggering estate taxes again. Wealth compounds inside the trust, protected from taxation, for decades or centuries. The family benefits, the tax bill simply doesn't exist. Trusts don't hide money, they relocate it, legally, into structures where the tax code's reach stops. Depreciation and paper losses. Real estate deserves its own section. Because the tax treatment of property investment is so favorable, it almost seems designed specifically to benefit people who are already wealthy. When you own a rental property, the IRS allows you to deduct the depreciation of that building over time. The theory is that buildings wear out, so you can deduct a portion of the structure's value every year as a business loss, even if the property is actually increasing in value. Even if you're making money, this creates paper losses, losses on paper that can be used to offset real income. A real estate professional, a category the IRS defines relatively broadly, can use these losses against their ordinary income. A large enough property portfolio generates enough paper losses to bring taxable income close to zero, while actual wealth continues to accumulate in the form of rising property values. Cost segregation accelerates this further. An engineering study breaks down a building into individual components, each depreciated on a faster schedule. The tax losses arrive earlier and larger. Millions in taxable income can be sheltered behind the wall of a building that is, on paper, disintegrating, while in reality appreciating every year. Charitable giving as a tax instrument. Philanthropy at the level of great wealth is rarely purely altruistic, not because wealthy people are incapable of generosity, but because the tax structure makes giving away money financially advantageous in ways most people don't realize. When a wealthy person donates appreciated stock to a charity, two things happen. They receive a deduction for the full market value of the stock, and they avoid paying capital gains tax on the appreciation, tax they would have owed if they'd sold the stock and donated cash instead. Donor-advised funds take this further. A wealthy person donates a large sum into the fund and receives an immediate tax deduction. The money sits in the fund, invested, growing tax-free. The actual grants to charities happen later, sometimes years or decades later at the donor's discretion. The tax benefit is immediate. The charitable impact is optional and indefinitely deferred. Private foundations allow even more control. A family creates a foundation. They donate assets to it and receive large deductions. The foundation is required to give away 5% of its assets per year, but the rest continues to grow tax-free. Family members can be paid to run the foundation. Expenses can include travel and events. The remaining 95% compounds untouched forever. Giving money away at this scale is itself a form of keeping it. Municipal bonds and tax-free investment. Not every legal tax strategy requires a team of lawyers. Some are built directly into the market. Municipal bonds are debt issued by state and local governments to fund infrastructure, schools, bridges, water systems. The interest paid to bondholders is exempt from federal income tax and often exempt from state tax as well. For someone in a high tax bracket, a lower nominal interest rate from a municipal bond can deliver a higher after-tax return than a higher rate corporate bond that gets taxed. The wealthier the investor, the more valuable the exemption. Roth conversions, health savings accounts, certain retirement structures, and opportunity zone investments all offer legal shelters of varying sizes. Each one reduces taxable income. Stack enough of them and the bill approaches zero. The system isn't broken. It was built this way, with enough doors left open that those with the resources to find them can walk through without paying the admission everyone else owes. What this actually means. The gap isn't about who earns more, it's about who wrote the rules and who can afford to use them. None of what's described here is secret. Tax attorneys publish explainers. Accounting firms advertise these services. Congress debates closing specific loopholes every few years and then doesn't, because the people who benefit from the loopholes are often the same people funding the campaigns of the people who would have to close them. The system is not accidental, it is maintained. That's all for today. I'll be making more videos like this, so subscribe if you'd like to see the next one.